I'm Ron Mazurski. I'm the founder of NIPE, and I'm currently a board member, and I'm an officer of NIPE as well. I'm acting as host this evening for this NIPE event. We've run online events since April of this year as a result of the pandemic, since we've been prevented from hosting the in-person events. We've been running those for many years. This event covers unique and proprietary research that was conducted by Phase 5 on COVID and its impact on banking and payments. We have today with us Phase 5, a well-respected market research firm that specializes in the banking and payments industry. Phase 5 has fielded a market research study this past summer that measures the impact of the pandemic by surveying 1,000 US consumers about changes in attitude and behavior toward their personal finances. And by the way, if anyone is interested, they've also run the same study by Canadian consumers. That's not what we're presenting today, but the information is there if you want to reach out and contact them. And I'll share that contact information later. The findings will serve from the study as a backdrop to discuss how banking and payment sectors need to reimagine and redesign the experience they deliver to consumers in order to meet their changing needs post-pandemic. So the main takeaways of this research focus on one, key changes in consumer financial attitudes and behaviors. Second, how COVID has changed how consumers interact with their bank. Third, how COVID is shaping consumers' customer experience and perceptions of the bank, and how COVID has changed payment practices and their attitudes. The main speakers you'll hear from today's session from Phase 5 are Steve Hansen, who is a partner with Phase 5, and Michael Delenko, who's also a partner at Phase 5. I'd like to thank these folks from Phase 5 for sharing the results of this study with us. I want to let you know that we will be sending out highlights of this research to all of those who have registered for the event, and you can each request a copy of the more complete research presentation that you will see here and you'll hear about today by sending a request into Phase 5, and I'm going to share their email addresses with you at the end of this session. I also want to mention that we'll be having a short networking session at the end of this presentation to allow attendees to meet other attendees during this short 20-minute period. We'll be randomly assigned to groups of 7 to 10 people just to meet and introduce ourselves, and even to discuss what we heard during today's session. Just stay on the current link and you'll be put into a breakout session. If you want to move to another session, there'll be a way to leave that session you're in and go into another session if you want to meet other people. And now, and on that note, let's go to the Phase 5 folks and hear their findings. I think we're starting with you, Steve. Would you take us to your presentation?
Yeah, absolutely. Thanks, Ron. And thanks everyone for making the time tonight, or I guess this afternoon if you're West Coast. We're glad to be here. We're glad to share what we've studied, and at the end, hopefully have some discussion with you about where this thing is going to take us and how we can get ahead of the curve. So yeah, I'm Steve Hansen. I am a partner at Phase 5 and I run the Minneapolis office. I am a relative newbie to the financial services field since I've only been working in this area for the last 5 years or so, but my colleague, Michael Delenko, is here today as well, and he's been working in financial services since he was 12, I believe, and you can see now he's nearly 30, so you do the math. It's a long time. Michael, why don't I let you introduce yourself?
Sure. Good evening or good afternoon, everybody. Thanks again for joining us today. My name is Michael Delenko. I'm a partner in our Toronto office. So Ron, thank you for the shout out to the Canadian study, which is fairly parallel to the one you're going to see tonight. So I work in our product and service innovation practice. So what that means is I do a lot of work with financial institutions on helping them develop and design new product and service offerings or revamped product and service offerings, and help them with go-to-market around that. In the spare time, I do a little CX and UX work for them as well, but primarily focused on that. And so my experience in the payments is fairly broad. I'll call it broad and narrow rather than deep. I do a lot of work with card credit card and payment card issuers on designing new products and services around their rewards programs or loyalty programs. Work on digital payments, IMT and FX, some commercial payments, and then P2P payment networks and fintech providers as well. And then some other players within that ecosystem, but I'll leave it at that. So that's generally the work that we do here. And then tonight, Steve's going to run you through most of the findings from our US study, and I will add some color commentary and talk to a couple of points at the end when we get into a discussion around some of the implications.
Great. So first, let me give you an overview of what we're going to present, although Ron did most of that already, but this just so you know where we're coming from and what you might be able to see. So we do a lot of work in the financial services industry, as you probably figured out from hearing Michael's background, and we have seen some interesting times, not to date ourselves, but we wrote out 2008. It's hard to believe that was 12 years ago already. We wrote out the dot-com bust before that. So this spring, as COVID hit pretty hard in March and even harder in April, we got together as a management team and said, hey, let's take the time to try to get a handle on the consumer response in terms of financial services. So how are people feeling the impact now? How are their behaviors changing? Where do they see things going in the future? And we wanted to go beyond anecdote. We all had lots of anecdotes, right? But and to be able to go back to our clients with some hard numbers so that they might have a clearer picture of the market and where it's going. So we fielded this survey in July, ending up with about 1,000 Americans who were decision makers in their households. And it has a good range of income levels and investable assets. And then in the results that you're seeing today, we balanced it for age to represent actual US age distribution. Now, the disclaimer for this audience is that our study was not designed for payments per se, but when Ron looked at the content of the entire study, he told us, hey, this audience is going to be interested in the findings that you have on financial attitudes and behaviors, which we wrapped up in sort of those first two items. Then he told us, of course, they'll want to hear about the specific results that we have on digital banking and payments. And finally, he said, there are enough of you banking people to want to hear about our findings that relate to the banking response to COVID. So that's how we've organized the presentation today. And what we'd like to do is show you some of the findings and then bring it all together with what we think are the implications for banking and for payments in particular. So without further ado, let's dive into what we know objectively about consumers' financial situations, as well as their subjective outlook on their financial situations. So the first thing here that I'll say is the obvious, that COVID is not making most people, except Jeff Bezos, any richer. Just the opposite. About a third of US consumers report a decrease in income. And that would be bad enough on its own, but as the economists say, behavior is king, whether it's rational behavior or not. And a good chunk of those households that have not suffered a decrease in income are still holding back spending. So about half of all households report a moderate or substantial spending reduction, and half of those had no decrease in income, which means they're just hoarding, or to be generous, they're being thrifty. At the same time, almost a third of consumers have delayed a major purchase. So this is a pretty real thing. Overall, it's a story that won't surprise anyone in this audience. Lots of people are losing income. Even more people are hunkering down. Where it starts to get interesting for banking, though, is in those last two bullet points on the slide. I call it kind of grim news for consumer products companies, maybe, but with a bit of silver lining for banking. So on the one hand, people see reduced spending as a long-term thing. On the other hand, there may be more savings out there to grab. You've got a quarter of the entire population saying they've increased savings, and that even includes 10% of the households that have reduced income. So, Michael, do you have any color to add to that?
No, other than we're seeing the same thing. I mean, from a banking perspective, that's telling us that there's more money to be had for deposits, and where that's been a perennial problem in the last. Since the last recession, trying to get new deposits, suddenly there's all this money floating around in savings accounts and under mattresses. So that's an implication.
Which they don't have access to. Okay, so The second slide here in the financial outlook section is, again, as you might expect, about young people, because young people they're taking a hit. In purely economic terms, they are disproportionately represented among those who have lost income. More of them are losing. And I'm sure probably almost everyone on this call has a young person in their life that is taking this hard in some way. I mean, or maybe you are one of those young people. I don't think I qualify. My oldest daughter is starting college this year, sitting at home taking online classes. It is definitely not living the dream, but she's at least grateful that she's not graduating this year, because you can understand how there could be a lot of pessimism out there. And in the bottom chart, you can see how the pessimism is just far more prevalent in the younger crowd. Michael, anything to add there?
Well, I'll just call out that if you look at the long term as well as the short term, that there's still that pessimism longer term, that these people, and young people in particular, are thinking that this is going to have a lasting impact on them in terms of starting a career, starting a family, being able to save money, being able to pay back student loans, et cetera. So it's a long-term impact that sort of worries me more than the short term. And it was disconcerting to see there wasn't much of a delta between those two bars on this chart.
Yeah. So before we go any further, I want to talk for a second as well about how we've broken out the results in the study. So in the financial industry, it's easy to get into a rut thinking about what predicts people's behavior. We say that people with higher incomes do this, people who are wealthier behave like this, or younger people do this kind of thing, while older people do this other kind of thing. And there's nothing wrong with that some of the time, because there are lots of behaviors and attitudes that correlate with or even caused by those variables. But it's rarely all of the story, and that's what this slide is about. So in this study, we slice the results in a variety of ways, including those common ones. And one of the interesting ones that you'll see throughout is about people that we bucket as having low engagement or high engagement in banking activities. Now, what engagement means is simply the number of banking services they have. So low engagement people have, by definition, only a checking and or a savings account, but no credit cards, no mortgage or other loans, and so forth. While high engagement folks have more of these services. Now, as you might expect, there aren't that many low engagement people. It's only 20% of the group overall, but 20% is a substantial number of people. And there are some other interesting things as well. So first of all, you might expect, okay, so these are low income folks. But in fact, they have reported anyway about the same income profile as the high engagement. Now, the two groups do skew a bit younger and less wealthy, or that's to say the low engagement are younger and less wealthy, but it's not a huge amount, so that's not the whole story. And the bottom line is it's an intriguing group, and the rest of the presentation, when you hear us talking about low engagement, well, that's what we're referring to. So in that earlier slide, we saw that there are certainly differences in financial situation and outlook as you move along the age spectrum, right? Younger to older. There's also this dimension that I just introduced in the last slide, and those who have low engagement with banking services are significantly more likely to predict a decrease in their spending after things go back to normal. That's the 34% versus 24% that you see in the chart there, which raises some interesting questions. For example, is there a particular service offering that could break through what seems to be a very financially conservative mindset, or maybe it's a reluctant to bank mindset, and unlock some of that spending, given that we know these people have incomes similar to the high engagement crowd? We'll talk about that more at the end, but in a nutshell, then, that's the financial outlook that provides sort of the landscape that we are working with here in the pandemic era. And in the next few slides, we're going to move on more specifically to the concerns that consumers have within this financial landscape. So let me start here at sort of the big picture aggregate level. The market movements during COVID have made a lot of people queasy about their investments. So as you can see, this is the very first bar at the top right. Investment performance concerns just dwarf the next most prevalent concerns. And just generally, like, So taking you over to the left-hand side, just generally, a lot of people are concerned about various financial matters. So that 34% number, if you flip it upside down, you think, wow, 2/3 of Americans are reporting at least some kind of financial concern. So let's dig in a bit to those other concerns below the one about investment. So looking at the next three, having enough income, incurring more debt, paying for mortgage or rent. What's interesting is that these concerns all tie much more to wealth, it turns out, than to income. And we've shown that here on the next slide. So the top portion here in the gray is about people who are concerned that they will not be able to make their mortgage or rent payments. And that's a pretty fundamental concern. But interestingly, it appears to be a concern that is tied more to wealth than to income. So if you look at that 13%, 15%, 13% in the middle, that is telling us that essentially the same percentage of folks are concerned about their housing payments, regardless of income, except at that very highest income bracket. On the other hand, it's much more helpful to look at wealth over there on the right. So folks without much in the way of investable assets are the ones who are far more concerned about making their housing payments. Again, let me emphasize, without regard to their income level. So it all makes a certain amount of sense once you see the data, but it's not the most intuitive result. And what's a little more intuitive is what you see at the bottom of the slide, that less wealthy people are likely to be more concerned about debt, which is what the two charts at the bottom are telling us. But even here, it's a bit surprising that income is not a better predictor. So why would that be? Let me tie this back to some earlier data we saw. So remember back on, I think it was nearly the first slide, when we talked about the bump in households that were saving, even including some whose incomes had been reduced during COVID. So this could all be connected into one larger trend, that people only feel secure with what they have on hand. So wealth on hand eases a variety of worries during uncertain times. Now, I mean, that sentence sounds a little cliche, but when you see the striving for savings in such a wide variety of financial situations, including among those who have actually lost income, you sit up and take notice, because the financial institutions who are able to capitalize on that, who are able to help consumers turn income into wealth during some pretty worrying times, they're the ones who will be able to nourish long-term relationships with those customers. So here is another angle on that. We're back to our groups of low banking engagement versus high. And here you can see their concerns are actually quite different. So if you look at the three items boxed in orange, the low engagement group is, those are the concerns. They are far less worried about the performance of their investments, which everyone else is worried about, and more focused on these kind of pedestrian concerns, paying for everyday expenses, paying for housing, paying off their credit cards or loans. But keep in mind that income profiles between low and high engagement groups are fairly similar. So this again points to an opportunity for maybe targeted wealth building, to actively seek out this group and offer them the right financial products to bring them more into the financial mainstream. So that's the last slide on the section of financial concerns. And what I'll wrap up with is to say that A, most people are concerned, they have financial concerns, but B, they are not concerned about the same things. They're concerned about different things, kind of depending on their situation. C, wealth alleviates everyday concerns more than income does. And D, this engagement with banking services is related to the types of concerns people experience. So let's now talk about what we have for digital banking and payments. Now, everyone knows this first headline, surprise, surprise, people are moving away from branches and ATMs. And it may not be surprising either that people now expect a future of increasingly online or maybe even exclusively online banking. But there's some detail in here that's sobering, or maybe kind of jogs your memory. You see that people under 45 are moving online much faster than those over 45. And as my colleague pointed out when we were discussing these results, younger people were already more likely to be online. So we are ending up in this situation where the people who arguably need most to be online, the elderly, are far behind their younger counterparts in getting there, which means for all the work that financial institutions have been doing on going digital, and even specific work on usability for older users and so forth, this indicates there's much work left to be done. And we'll come back to that thought in a minute, and also in the wrap up. But first, I want to get to the idea of what financial activities feel ordinary or perfectly comfortable to people. So let's take a look here. Those big blue bars are the people who are very comfortable with doing things online. So the black bar is those who are not at all comfortable. So right now we're just talking about the people, we're leaving out the people in the middle who are maybe okay, but not excited. Now, it is true, as the headline says, that lots of Americans are pretty comfortable with the first activities on the list, but the numbers also indicate that there is work to be done. You can see something that, frankly, many of us on this presentation would think nothing of, like applying for a credit card online. That still falls just short of a majority who are very comfortable. And there is still some discomfort to be overcome. As you descend the graph, obviously the activities become increasingly less comfortable. So let's take that thought and flip to the next slide to look at the same activities by age group. So this is the other part of that sobering story about digital banking for the 55 plus crowd in this case. So for every digital activity, they have far more discomfort than younger Americans do. You look at those black bars. So for mortgages, you're talking almost a third who would not feel at all comfortable applying online. Now, I'll grant that some of the challenges you see here are not things that the financial industry can solve alone, because it involves the whole digital ecosystem. I mean, if you take something like that second item there, downloading a mobile banking app, it's highly likely that the discomfort is not maybe just about banking per se. It's probably discomfort with the app download. But still, overall, the challenge that I see here is, how do you reach this demographic, overcome concerns, fears, usability issues, and give them the tools they desperately need to continue their financial life online? So again, we'll talk about this in the wrap up at the end, but for now, let me move on to payments. So in this first slide, we are able to put some hard numbers to a trend that all of us have seen and experienced, which is the move away from cash. And it's pretty stunning. You've got about a third of Americans using less cash or having stopped using it altogether. And while you can see that credit cards as a payment method have made some of the biggest gains down there in the bottom left, in the middle, you've got 1 in 6 Americans who started using or are using more of digital payments. And keep in mind, this was in July, which was just 3 or 4 months into the pandemic when we asked the question. So you can be sure it's only gone up since then. So the question is, who's making the changes? Is it even across the board, or are certain groups doing more? Well, let's start with the expected. It's those young people again. Indeed, as you would expect, they are taking to online banking and payments as naturally as fish to water, as naturally as they took to Snapchat. I'm going to date myself. Snapchat is probably old stuff now. But there absolutely is here the trend that you would expect and that we've seen elsewhere, that 55 plus is far behind. But that's not the whole story. So let's go to the next slide for a different view. It's not just young people who are doing more digitally. So in this slide, we're going back to that low banking engagement demographic that we've been talking about. You can see that the digital payments number for them down there at the bottom right is much higher than it is for the mainstream. So 25% have started doing it or are doing it more. And just in general, you see that the low engagement numbers, the blue bars, lots of these people are new to mobile and online banking, a lot more than the high engagement crowd. So if you're a financial institution and you're taking, let's say, a data analytics approach to finding people with the greatest potential for new services, this could be another approach outside of the standard sort of age, income, wealth targeting. Now, in our final section here, I want to speak directly to those of you in banks and credit unions and give you the hard numbers view of how consumers think you've performed vis-a-vis COVID. And I'll give you the spoiler right now. The story is actually some good news, along with some opportunities for improvement. But first, let me hit kind of the good news. Consumers are pretty happy. To me, it was surprisingly happy at overall. When we asked them to rate their primary financial institution in terms of response to COVID, we got a lot of people saying they knocked it out of the park. I mean, 9 to 10 on the scale. And the vast majority saying it was at least reasonably good. And more than a quarter are even saying that they have a more positive view of their bank since COVID. And this wasn't any particular group. This was true across the board. All right, great. So where's the opportunity for improvement? Well, you could say at the very least that the big four have apparently a little catch up to do with credit unions over there on the left, but there's probably more of a message here on the next slide. So the headline is positioned in a glass half full kind of way. Banks are doing well with 55 plus, with lower income households, but there's definitely room for improvement here among the wealthier and the younger. And given how important those two demographics are to the profitability and future of the industry, well, it's worth paying attention. But I guess here, Michael, let me hand you back the next slide to talk about some of the details of the response.
Yeah, so in addition to asking our respondents and asking Americans what they thought about how their bank performed overall, we asked them to rate their bank or credit union's performance on a range of different attributes. And we saw sort of a pattern here that banks and credit unions did a particularly good job at sort of being able to meet the day-to-day banking needs of Americans as the pandemic unfolded. So, you know, again, this is a 0 to 10 scale, so it's got 11 points and 45% of respondents rated it top 2. So that's a really strong rating in terms of being able to keep sort of the wheels in motion and the gears churning on meeting their banking needs, even when branches were closed down or were in reduced service situations. And part of that goes to the digital channels and tools that were made available. So when people couldn't go to the branch or do their banking in person, if that's the way they were used to doing it, they were kind of forced to go online. And again, the scores there are pretty good. You know, more than a third gave excellent scores to being able to provide them with digital tools to allow them to continue to bank. In terms of being accessible, we saw really good scores there. And keeping consumers up to date on what's happening with their bank in terms of safety protocols, opening and closing hours, what's been closed, is the drive-through open? So that kind of more prosaic communication that the banks did really well on, and also in terms of being proactive or reaching out. So all these scores are actually pretty good. They fall off a bit when you start thinking about things like flexibility, seeing that there was some kind of focus on the community, being able to provide consumers with useful financial advice and planning. Again, so are consumers really turning to their banks or credit unions when they see that their income's gone down, when they're worried about their investments? So, you know, that's maybe an area where there's an opportunity for improvement to give them more proactive advice and planning tools, to keeping them informed of specific offers that are coming. So we saw the banks do well on more sort of generic communications about, you know, we've got hand sanitizer, people are going to be wearing masks or not, and the you know, here's our new hours. But in terms of saying, you know, am I eligible for these kinds of government loans? Can I get any kind of deferrals? So people felt a little more in the dark about what was available to them there. And then offering financial relief. There's a sense among some consumers that the banks just didn't do as well as they could there in terms of, you know, stepping up to help their customers and when there's a time of need.
Good, thanks. We also gathered some data here on institutional trust. And what you have overall here, again, is a mostly good news story. The trust has gone up more than it's gone down, and it has gone up uniformly across institution types. So one side note here on the sort of big four versus credit unions, a few minutes ago, we saw that in terms of overall COVID response, credit unions were blowing it out of the water. Lots of their customers were very pleased. And for the big four, it was pretty positive too, but less so. So it's interesting here that the increase in trust is small at credit unions and somewhat higher at the big four. I guess the thing to keep in mind is that unfortunately we don't have a base here. And no offense to the big four folks listening today, but consumers' trust in the big four might be rising off of a lower base. So we just don't know how the trust levels were pre-pandemic. Michael, I'll turn it to you for the next slide, just for a few other details on trust.
Yeah, sure. So when they said that they had a change of trust, either positive or negative, based on how their bank or credit union had responded or performed during the pandemic, we just asked an open end on the survey and asking them to tell us, well, why did your trust increase or decrease? And it was interesting, sort of the contrast here. So when there was a decrease in trust, it seemed to be that people were thinking that the banks were more concerned about their stockholders, their shareholders, and their investors than they were about their customers. So we saw comments about, well, you know, they're more concerned about buying back stock than they are about taking care of the little guy. So that's a general flavor of some of those comments. The other big one here, 1 in 5 people who said their trust went down was because they weren't offered any help. They didn't hear anything that was potentially positive for them in terms of a deferral or a reduced rate or any kind of financial relief from the bank. They also noted that they didn't see fees go down, that, you know, even though everybody else's income's taking a hit, we don't see the banks be willing to lower some of their fees or service charges. So that was a pain point for some consumers. On the flip side, those whose trust went up was really that they saw them being supportive. They saw a response to COVID that was proactive, that focused on safety, that focused on employees and clients. And that they seem to be more customer focused. And it was interesting here that clearly there must be some FIs that did lower their fees and interest rates and others that did not. So there you can see the break there with the 8% towards the bottom of that chart. Said the trust went up because they got a break, whereas we had 13 who said it went down because I didn't hear anything of the sort. So again, there's sort of a yin and a yang here, but it is interesting to dig into that a little bit and see some of the reasons there.
Great, Michael. So thanks for wrapping that up. And that concludes our summary of the findings themselves. What we'd like to spend a few more minutes on here is going through what we see as the key takeaways. And we've boxed these into 5 areas that capture what we think are sort of the essence and the subtext of the detailed findings that we just went through. So the first one is this idea that saving money is the new black. Thriftiness is in the air. 'Tis the season to be cheap. Whatever you want to call it. It's an important trend to dig into. And the second one is pretty simple. How can we find ways to help consumers deal with investment worries? The third has very wide implications. COVID has thrown gasoline on the little spark of digital financial services. So everyone now is going digital. Your grandfather is going digital. What are the implications? Similar idea for number 4. COVID is forcing digital payments into the mainstream. And what does that mean? And then finally, there's sort of this common thread of communications through all this, and we'll try to pull that thread to tie things together. So Michael, I'm going to let you lead it off with my favorite topic, talking about how Americans are going thrifty. And I love this because for practically my whole life, I've listened to The Economist wag on about what terrible savers Americans are. And now maybe I get the chance to say the opposite. So,
yeah, I think we're worse up here. Yeah. And yeah, this is an interesting trend, and we saw it, just FYI, across North America. So there is a new incentive caused by the economic shock of the pandemic to save, and that could be because your income's gone down and you need to worry about how you're going to make mortgage payment in 3 months from now. So you've got to make sure that you're counting every penny, or it could be because you're still making the same amount of money, but you're worried about your job because the economy seems all of a sudden a lot less certain than it was a few months ago. So people are stocking more away. So what can banks do and FIs do to encourage this? And the first is sort of really focusing on smarter promotions to capture savings. So, you know, when you look at how FIs typically try to attract savings, it's bonus offers, right? Back in the day, it used to be toasters, and then it was iPads. And now it tends to be cash. You know, open an account, we'll give you $300 if you do one of these or 2 or 3 things, or $500 or $600. It depends on the bank, it depends on the market, but that seems to be the general approach. But maybe there's some better ways to think about that. And obviously retention could be an issue. So we're seeing that creep in to new, deposit attraction promotions. So when banks are looking for deposits, they're looking at ways to encourage longer term. So think, how do we keep you? So we don't want to just attract somebody who's going to bring over $1,000, take the $100 bonus, keep their money there for 3 months and then move it out. So really, how do we find a good saver? And obviously there's some analytics. You can look at your own good savers longer term and identify good candidates for that. You can also look at your existing clients where you can identify a prospective good saver and make your offers more targeted. So if Steve, who's a good saver, is at your bank, you might say, Steve, we're going to give you an extra quarter point on your CD or your savings account. Whereas me, who's a spendthrift and is going to stop his regular saving program whenever he can, I shouldn't get that offer because I'm probably not as good a customer from a deposit perspective. The other thing too is that ensure that you're rewarding longer term behavior and you're tying into consumers' values, what's important to them. So thinking more creatively about your promotions to do things that match what consumers are interested in or what is important to them. And we'll talk about a couple of examples of those in a minute. A second thing that FIs can do here is really using digital and AI to make savings seamless, especially with your younger cohorts. And I'll show you an example of one of the clients I work with here in Toronto has done, but I'm sure there are US examples, or if not, it's an easy implementation. But you can develop something like a personal sweep services that business accounts traditionally have had that can identify sort of micro savings opportunities by a consumer looking at the patterns of their spending, what's going in and out of their account, and then move that money over to a hidden account that reduces the temptation to say, hey, look, I have all this money over here. Let's go out for dinner, or let's go buy a new Peloton. So the way to get across that behavioral temptation of breaking the piggy bank. And then for younger consumers in particular, you can use feedback and gamification to make that behavior more sticky. So you can show them where they're tracking to with their savings. You can reward them for consistency. You can reward them for increasing their savings rate. So there's lots of ways to gamify this that FIs can take advantage of to continue attracting those additional savings that consumers are piling up because of the pandemic. And then sort of more longer term, or maybe more holistically, so you've got this consumer that's saving more, there comes a point in time where that savings, what are you going to do with it? You could keep it in savings and CDs, but we've got traditionally low interest rates and they're probably going down before they go up. So really looking at it from a planning perspective to understand why savings is important as a lifelong habit. How you can help them draw a path from savings to wealth management, where you can cross-sell and upsell to higher value added services and solutions. So those are some of the things that just some talking points, some thought starters in terms of how to encourage this or benefit from this thriftiness. I've got a couple of just sort of examples here. I was scrolling through what's currently on the market for attracting deposits from banks. And, this is number 22 on a list of, I think, 50. So it's nearly the bottom half. But the rest of the top, everything before this was get $100, get $200, get $300 if you open a checking account or a savings account. This one I thought from Citizens Bank was interesting because it's offering the same bonus. It's $1,000, but it's basically tying it to a longer term college savings plan. So you're opening up a plan for your kid. And you're going to get this money when your child turns 18. So you're going to have to keep it in there for 6 years, but you're going to be encouraged to save along the way. So you'll get a benefit from Citizens for doing that, but hopefully you'll also see the benefit of having saved for 6 years and seeing the compounding and the returns that you're getting from that account. So I thought that was a little bit of a twist and try to tie it to a longer term goal. The one here on the right is kind of a little harder to explain from the what you see here, but it's called Nomi. I'm not sure if people are familiar with it. One of my clients here in Toronto launched this just over a year ago, and what it does is it uses AI and it applies an AI layer over people's checking and savings accounts to see, what's the money coming in, where's the money going out. It categorizes it, but it does it in an automated way, so the consumer doesn't have to do anything. They just have to say, yeah, turn it on. And then it pushes out insights to them to tell them how they're, what they could do to improve their cash flow. Hey, you spent more money on Uber this month. Hey, you're spending a lot of money on takeout. Do you really need to? So it's giving little nudges, behavioral nudges, plus positive things. You save more this month, so good for you. But the feature that I wanted to highlight here that they have is something called Find and Save. So after a few months, it gets to know the sort of in and out patterns of the account. And then what it does is if you turn it on, it'll sweep up to $50 a week away from your regular checking account into a higher interest savings account that's a little bit hidden. It's not totally hidden, but it doesn't pop up on your list of accounts. So what it does is it looks for opportunities of saving. It says, hey, even if I take $50 out of Michael's account, he's still going to be able to make his mortgage payment. And typically he spends $700 a week at the grocery store and at the gas station. He's still going to be able to do that, but I'm going to take that $50 and I'm going to move it over to savings so that he doesn't spend it on something frivolous. So using that AI, I thought was a great example. Another theme here was the management of investment worries. And we saw earlier on that people were really concerned about their investments. That was their top financial concern. And I don't know why I keep looking at the stock markets in somewhat disbelief, but people are concerned. So again, there's a product opportunity here, and we're starting to see some FIs come out with products that really focus on managing volatility. Things like target outcome funds, asset allocation funds that start to use non-correlated asset classes and hedging to minimize risk, minimize the downside, but also provide a little better upside that you're going to get with fixed income. So we're starting to see some of the asset management companies come up with this. So that's, I think that's something that we'll see more of if the environment stays similar, if we go through another series of lockdowns with wave 2 and 3 of this pandemic, and then the hangover. If there's more market volatility, I think there's going to be more appetite for products that help the consumers manage that. And then the second obvious one is to offer planning. I read an article yesterday saying, where are all the financial planners? And this is when we need them. So this is where financial institutions that have financial planning capabilities really need to be marketing that and servicing their clients with that, and figuring out a way to do that that's profitable beyond the top 10% of income and wealth in the country where they get all the attention. And one of the ways you can do that is through robo-advisor type platforms. So we're seeing more of that. It's still a small proportion of overall assets, but it's got some really good features that are helpful for people like millennials and Gen Zs who don't want to get into the nitty-gritty and like the digital experience. And it's simple for people who may be more emotionally involved with their money. It does, automatic dollar cost averaging, and it does emotion-free rebalancing. So those services are, I think, going to increase in popularity moving forward. And then again, building on those savings trends that we saw in the last time. So if you're encouraging savings, pull that money from just a regular savings account or a CD into an investment product that allows the financial institution to earn probably higher return, but also to help consumers make more of their savings, especially in low interest rate environments. So again, just a couple of examples here, nothing to really play on here. Here's some example of some low volatility ETFs. We've seen those gain in popularity. Underneath that in our orange is just a boring chart that I pulled out from, I think it was Vanguard. Yeah, Vanguard, they did a survey of advisors' alpha strategy. And basically, self-serving as it is, there's still some good evidence from other studies as well that show that people who work with an advisor, people who have a plan tend to do better longer term and in the range of 3%. And, it doesn't sound a lot, but, that adds up over time with compounding. So again, to push that financial planning. And then the top there is our our example of our robo-advisor, where you have automatic investing, takes the thinking out of it. Our third theme really was around, COVID is going to accelerate the digital transformation that was happening anyway. So that means, you need to make sure as a financial institution that at the very least you have account opening and onboarding down. And that's where we're seeing the advantage of the bigger financial institutions, the big banks that have the technology infrastructure and the money to spend on that, and the resources to spend on it. There's going to be more of a gap between them and the regional and smaller banks that are still figuring this out. This should be available for all products, though, not just for checking or savings accounts. It should be mobile first, because that's where people are going, and it should be super easy, not just easy, but super easy. It shouldn't take you more than 3 minutes to open an account online. Leverage digital for non-day-to-day transactions. We saw there was appetite for that, and there just isn't a lot of it out there. Mortgage renewals, change virtual advice. The banks have tried virtual advice, and the wealth managers have tried that, and insurance companies have tried that for years. Well, here's an opening to really make that work and make it stick. So offer something that's going to be a compelling experience. People will get used to it, and then even after the pandemic ends, you'll have people who want to continue using that experience. It's like people working from home. Some of us will come back to the office. Some of us will probably stay at home longer term. Customer service, you can leverage digital for that, for things like AI chatbots, and making your digital feel more like a personal interaction. A lot of digital interactions are really cold, and people do value that face-to-face and that human touch. So use leveraging digital to that as a trend that we're thinking is going to accelerate. That said, even though we've been hyping digital, don't close those branches, or at least not all of them. There's going to be a lot of customers, and not just your elder customers, probably more of them though, but who value that in-person service. But then maybe rethink the branch and focus on value add, cross-selling, wealth management, as opposed to day-to-day banking transactions. And then don't forget the older folks. As Steve pointed out earlier, these consumers are the ones who probably need the help more than ever now, because they weren't adopting digital. And now they're in a place where some of them are anxious and they feel like they have to. So how do we serve them better and in a way that they'll continue to use digital after the pandemic? So, maybe develop apps that are really targeted at seniors with limited digital banking and financial services experience. Those could have less functionality, more optimized user interfaces, bigger font size, bigger buttons for my dad who keeps going to the bank during the pandemic because he can't do anything on his phone because it's too small for his thumbs. The other thing too is, think about communications programs that focus on moving basic transactions online for seniors or older consumers, and then maybe even incent them to do so as a starting point, just to get them going. I mean, the most important thing is to begin. So something that triggers that initial trial is key for this particular demographic. Just have a couple examples here. The one at the top is a mortgage renewal app. I'm flummoxed why not every financial institution that offers mortgages would not let their consumers renew online, as opposed to have to go to the bank and haggle. The other thing here on our green people on the right, this is from was this City or Chase? I can't remember. This was a campaign that was done to encourage seniors to bank online, and you can see our slightly sad-looking elder cohort here from their videos. But they produce a series of videos that basically explain how do you do it. It goes through the frequently asked questions, and it does it from a way that shows the senior represented. So you're not seeing all these digital services being promoted at someone who's 23 and you're 53 or 63 or 73, and you're looking at that and go, well, clearly that's not for me because I'm not a millennial or a Gen Z, so they ignore it. So in this case, they took the smart move to focus on their audience and develop something specific for them. The one in the bottom here is an online account opening feature. And I just wanted to point out, there's just two things I like about it. One is you can open an account here, even if you've never dealt with this institution, in a matter of 5 minutes or less. And the other nice thing about it is you'll notice those coffee cups on the right. I shrunk it down a bit for the slide, but just the way that they tried to present a human kind of dialogue to this. It didn't sound like a bank. It sounded like someone talking to you, like maybe if I went into a bank and talked to a CSR. So it really, like, let's get to know each other. So you got a couple of coffee cups, and it asks if, it's very dialogical in the way that it works. And it sounds like you're dealing with a person as opposed to dealing with an app. And that's something to be commended. Sorry, Steve, you can go on to the next one. And then obviously digital payments are going to accelerate here. So do you have a P2P offering today? If not, you should. If not, if you can't build one yourself, leverage third parties. One thing we saw was banks increasing their trust at least a little bit. And fraud is a concern among some non-bank players, and more so now that we're seeing in the pandemic with some of the P2P platforms experience more phishing and fraud. So banks can leverage that. Money transfer and FX services is something to look at. And then new solutions for identity verification. I'm thinking things like third-party services that help allow people to verify their identity and biometric authentication. We're going to see more of that. And then finally, we saw that rewards are an issue. So with your payment program, take a look at your rewards program. Is it still relevant? If you're offering travel rewards, is that something that people care about right now? Are there new meaningful rewards that you can develop based on lifestyle values, et cetera?
Yeah.
I think that's just about it. Oh, yeah. So here's a couple examples. The one I'll put at the bottom here is a rewards program where the bank decided to give some rewards points to frontline workers so that they could travel after the pandemic was over. And I'll skip the others, Steve, just for time.
Yeah, just for time. And I was going to say that sort of the same thing applies to communications. Basically, Michael has said most of the things I was going to say about communications, which is that it's kind of a super takeaway. It crosses pretty much every category we just went through. And it's broadly applicable, but I think in the interest of time, just go through the bullet points yourself. And I think that really concludes our conclusions. And I just thanks everyone for tuning in. We are happy to entertain questions if that's in order. I think I need to turn it back to you, Ron, to wrap up.
Yes. Well, thank you very much, Steve, and thank you, Michael. This is great information. I especially liked the implication section. I think there's a lot more that could be said about that. The so what? What happens now that we have a lot of these learnings? How can we use it to impact our clients, consumers, and vendors in the marketplace, as well as financial institutions? A couple of questions have come in, and I just wanted to throw a couple of them at you and see how you would handle it. Some of them are, maybe direct from the research, and others might be you being quick on your feet. Hopefully that's okay to throw those your way. The first one was, is there potential for fintechs based upon the findings of this research? What can fintechs learn from this? How does this maybe affect their business and their approach to things? Are there specific types of fintechs that might have better opportunities as a result of the pandemic?
Michael, you want to take first?
Yeah, sure. That's a broad one, but yeah, there certainly are opportunities, and one of them is to ensure that they can, they're going to benefit from the P2P payments in particular. I think, especially in the States, just given the ecosystem in this country, and they will. So there's a lot of opportunity for them there. I think the danger, though, is they've developed some very frictionless payment experiences, and the problem with those is they might be a little more open to fraud, to phishing. So they're going to need to work on trust, I think, is an opportunity for them. I think the other opportunity for fintechs is to work with some of the FIs that don't have the technology infrastructure in place to develop really customer-focused, good user experience payment and digital banking solutions. So to act as a sort of provider to the financial services institutions, I think is another one. And I think in terms of wealth management, I know it's been slow to grow, but I really do think that now is a good opportunity for them to show the value of things like automatic investing, robo-advisors, whatever you want to call it. I think those are three areas that I would look at for fintechs.
Yeah, that's great.
More than I had.
If you're okay, I'll throw you one more, and then I think we're going to have to come to a pretty quick stop. Is that okay? One more?
Sure.
We talked a little bit about the impact of the pandemic on people's spending behavior. And specifically, we know that travel has been impacted, dining has been impacted. What are payment companies to do with this changing consumer mindset? Is it more promotions? Is it changing up the types of benefits or value proposition? Any thoughts on that?
So is the idea to how to capture the payments that they've lost, the transactions that they've lost from things like dining and travel?
Yeah, so those are not in favor right now. Obviously,
Yeah.
spending volume has gone down in those areas. Are there alternatives that the payment companies can do to generate more volume to take up the falling volume in other areas?
Yeah, I mean, to me, it's kind of follow the money, right? Where people are spending. But it's a good question because I haven't thought through carefully the implications there. But you know, obviously, we're seeing more payments in things like home entertainment. Right now, heaters are flying off the shelves here because people want to sit outside still and have friends over for cocktails, and it's getting cold. But so there's a bit of the follow the money. But I mean, I guess the issue is, you know, are people just going to use their regular payment services for that? But I'm there thinking I would use my Visa card for booking a flight. I'll use it to buy something on Amazon.
You know, it's one of the things I've been thinking about, and it might be on target or not, but something like healthcare payments in the United States is a big deal. There's, you know, $500 billion of spending that that are out-of-pocket expenses, and a lot of that doesn't go on credit cards today and might be paid through other means.
Right.
You know, is that one of those areas for payment companies to start thinking about increasing promotions and opportunities to get that type of payment?
Sure. I mean, if they could develop a value proposition or a payment method that captures that out-of-pocket spending that Americans are spending on healthcare, and they're probably, you know, there's probably more spending in the current environment, or there will be, because there's going to be pent up demand as well as emergency spending. So is there a way that payment companies can develop something compelling there, either through rewards or through point of sale offers? You know, there's a lot of things they could look at that there's a big category that I hadn't thought of right away yet.
You know, one other thing to riff off, if we have 30 seconds more, is so Michael was talking about how, you know, follow the money, right? So one of the areas, and this doesn't come out of the study, but my own personal experience, is getting the payments to be accepted by the kinds of people that kinds of institutions, companies, whatever, that consumers are doing business with. Like, how many times have you gone to a place where, or done a transaction where actually digital would have worked really well, but the person doesn't accept it, the company doesn't accept it? I think looking at how quickly the environment is changing, like that's to me where some of the focus needs to be, is getting the acceptance end ramped up.
Yeah, no, that's a good point, Steve. Yeah.
Guys, I'm sorry to do this because there are more questions, but thank you for your time, both Steve and Michael. I need to kind of wrap this up now. As I mentioned to everyone still on the call, Phase 5 is going to be happy to share their findings with you. NIPAY is sending out to all registrants of this session a copy of their top line research report, and that'll go out either tonight or tomorrow morning. I also want to let you know, if you see up on the screen now, the slide that's there, if any of you want to have a copy of the full presentation deck with all the detail on it, just send an email to Steve Hansen or to Stefan Segal, both of Phase 5. You can see their email addresses there. Shoot it to one or both and ask for a copy of the presentation deck, and they're happy to send it out to you. I kind of want to just end by saying thanks everybody for attending the NIPAY event, and we'll be having more sessions coming up each month. And thank you for hearing Phase 5's research, and let us know if you have any thoughts about it, anything that you want to hear more about or have an interest in. If you have any questions for us, please don't hesitate to reach out to either Steve or Stefan or Michael or me. And we have these additional sessions I mentioned coming up. The next session is going to be held on November 17th from 12 to 1 p.m. Eastern Time. The topic is the ABCs of central bank digital currency. And we'll have three panelists, Dave Birch of Consult Hyperion, Chris Skinner of The Financer, and Kevin Petrasic of Davis Wright Tremaine. He'll actually be the moderator of the session. And then the final event of the year, which will be the first week of December, we're going to have a session on fintech demos and a panel of companies that are going to be the announced winners of the Money Transfer Awards in 2020 at the upcoming International Money Transfer Conference in mid-November. So shortly after those winners are announced, there's going to be, three of them are going to be invited to demo their products for us and talk about their products and answer your questions. More details of this will be coming up to you guys shortly. Please feel free to invite any of your friends to join NIPE and to attend future meetings. You can hear from leaders in payments and fintechs about leading research and obviously trends that we're beginning to see in the industry. For any of you that would like to continue on, we're going to have networking sessions for the next 20 minutes. And just stay where you are, and Bill or Nikki will be separating us into groups of 7 to 10 people, and magically we're going to just appear in these groups.
Okay,
Thanks
so,
again, everyone coming. Yes, is there a...
Yep. So I'm going to go ahead and do that. It'll be about 20 minutes. You'll get a 2-minute warning when it's going to come to an end.
Okay.
All right.